Welcome to The Explainer. I'm so thrilled you're here today because honestly, the market intelligence briefing we're looking at from July 2026 is absolutely fascinating. We're going to unpack this highly paradoxical thesis called the two-speed economy, because right now, we're looking at a global market that is quite literally tearing itself into two totally different directions. And to figure out where we're actually headed, we've got to look at these incredibly powerful yet completely opposing forces at play.
Okay, let's dive right into this. If you just, glance at the surface level of the major indices, everything looks incredibly smooth, right? Super prosperous. But underneath that shiny surface, we've got this bumpy, highly conflicting topography. Entire sectors of the economy are just pulling in radically opposite directions, and it's creating this immense friction.
To navigate all this, here's our market intelligence roadmap for today's explainer. We'll start with a macro overview of this two-speed economy. Then we'll break down speed one, the AI hyperscale boom, before sharply pivoting to speed two, consumer contraction. After that, we'll uncover the hidden market fault lines. And finally, we'll map out exactly what to watch next.
All right, let's kick things off with Section 1, the two-speed economy macro overview.
So zooming out for a global macroeconomic snapshot of where we stand right now, the dichotomy here is just staggering. Over on the equity side, tech is doing all the heavy lifting. I mean, we see the S&P 500 hitting 7,543, and the NASDAQ is leading those market gains all the way up to 26,206. But when we pivot over to commodities, the story completely fractures. Despite strikes in the Middle East, crude oil is actually dropping. It's sitting at $76.30, pretty much shrugging off those geopolitical shocks entirely. Meanwhile, gold is seeing massive safe haven accumulation, climbing up to $4,130 an ounce. So what does this all mean? Well, it tells us investors are incredibly divided right now. They're simultaneously buying into extreme tech growth while aggressively, almost frantically, stockpiling defensive assets.
Moving on to Section 2, Speed 1, AI hyperscale, our massive growth engine. $1.5 trillion. Just take a second and let that number sink in. That's enough to boggle the mind. That is the projected global big tech cloud and AI infrastructure spend by 2027. This absolute barrage of hyperscaler spending news is so massive, it's actively neutralizing any of those broader market fears we've had about rising borrowing costs or excess computing capacity. It's a real game changer.
To see what this spending looks like on a corporate level, just look at Meta. They're executing a plan right now to double their computing capacity to 14 gigawatts by next year. And at an estimated $38 billion per gigawatt, that implies a jaw-dropping capital expenditure of $266 billion from just one single company. That's unbelievable.
Now, let's trace how this demand builds through the broader economy because it creates this massive trickle-down effect. Step one, of course, is the hardware base. We've got Micron Technology accelerating a $250 billion U.S. investment plan just to produce memory chips. Then, step two flows right into the broader supply chain. There's $3 billion earmarked specifically to strengthen the U.S. semiconductor ecosystem, which includes some massive financing down in Texas. And step three? This is where it gets really fascinating, the pick and shovel plays. Specialized turbine manufacturers are suddenly seeing this surging dual demand. They're building for aviation airlines, sure, but now they're also building turbines to power these massive new AI data centers.
Which brings us to Section 3, Speed 2, Consumer Contraction, the defensive reality anchoring us down.
Let's pivot sharply here because everyday consumers are getting squeezed from two totally distinct directions. First up, the real estate squeeze. The median home price just hit an all-time record of $440,600, all while 30-year mortgage rates are stubbornly hovering around 6.5%. And the result? Existing home sales have unexpectedly dropped to 4.09 million. Then, second, you have the retail and staples squeeze. High gas prices are seriously straining everyday family budgets, and that's leading directly to slowing sales volumes at massive, everyday mainstays like PepsiCo and Costco. The everyday family just simply has less capital to deploy, so we essentially have an unstoppable AI force meeting a very immovable consumer object.
Now for the most crucial part, Section 4, Hidden Market Fault Lines, where these two speeds collide. Now, what's really interesting about this slide is this fascinating tale of two completely different volatility gauges bridging the boom and the bust. The VIX, which measures the broad S&P 500, is reading at a historically calm level of 18. totally chill. But the Voldex, measuring the NASDAQ 100, is flashing extreme expense. We're seeing what's basically a lottery ticket phenomenon. Individual traders are driving record options volume in tech. Just to give you an idea of how extreme this divergence really is, SpaceX's implied volatility is currently trading at 3.5 times that of the broader NASDAQ 100. That is wild.
And when we look historically at the semiconductor index, or the SOX, we're seeing a technical setup that absolutely demands our impartial attention. The index has moved 3% up or down 15 times in just the last 30 trading days. That specific extreme high volatility bounce, that was last seen all the way back during the dot-com era in 2000. Historically, and we're talking 1995, 1997, 2000, 2007, and 2020, this exact technical signal has preceded significant market drawdowns of 17% or even worse. So you got to ask yourself, where does the market's structural integrity actually lie? Well, this breakdown of forecast Q2 earnings growth paints a pretty clear picture. Micron is expected to drive 21.1% of all net income growth. NVIDIA is driving 19.6%. And the other 498 companies in the S&P 500 combined, they make up the rest. Let that sink in. Over 40% of the entire index's earnings growth rests almost completely on the execution of just 2 chipmakers. That is a truly historic level of concentration risk. Adding even more pressure to this highly concentrated sector is a massive geopolitical tech race playing out globally. In the US, players like NVIDIA and SpaceX are dominating hardware, while OpenAI and Anthropic lead the model race. Then, over in South Korea, SK Hynix just raised over $26 billion in the largest ever US market debut by a foreign company. Meanwhile, in China, massive capital raises are fueling some incredibly aggressive price wars. Companies like DeepSeek are now driving their operation costs down to literally just 3% of OpenAI's models. So we are looking at a fiercely competitive global landscape that's constantly pushing the boundaries of both cost and capability. And bridging this global tech race is the physical reality of our supply chains, which represent another massive hidden fault line. Global stockpiles right now remain perilously low, and Middle East tanker crossings have declined following those regional strikes. Yet, at the exact same time, we're seeing these incredibly timed capacity surges, like Aliko Dangote's $20 billion Nigerian refinery reaching full capacity. It's perfectly positioned to supply global markets while completely bypassing the Strait of Hormuz. The physical routing of the world's energy and supplies is just totally realigning before our eyes. Let's bring all these threads together. Section 5. What to watch next as we navigate Q3 2026. Navigating this immediate future, it's going to require a masterclass in balance. Portfolios and businesses alike have to juggle this gravity-defying momentum of industrial tech spending and hyper-funded capex cycles, right up against the defensive reality of stalling housing volumes, shrinking retail sales, and a consumer base that is, for all intents and purposes, entirely tapped out. Because of this delicate balancing act, we're seeing some intense, real-time corporate survival pivots. I mean, look at Netflix. They're exploring live TV and bundling as their total viewership share drops to 7.8%. Volkswagen is undergoing its second major overhaul in just 2 years, actually planning to have its car lineup just to protect its factory jobs. Over in healthcare, U.S. biotechs are radically increasing operational secrecy to block copycat competitors. And even the absolute leaders aren't immune. OpenAI is going through a major leadership transition as their number 2 executive steps down right ahead of an anticipated IPO. Basically, every single company is frantically maneuvering within this split economy. So what's coming up? In the very near term, here's your Catalyst Watch timeline. In just one day, we're going to get a direct look into travel consumer health when Delta Airlines reports earnings. In 5 days, we hit a major macro catalyst with the expiration of the U.S.-Iran ceasefire, and that's against a backdrop of dangerously low oil inventories. And then in 14 days, global attention is going to shift heavily toward culture, with massive World Cup matches drawing literally billions of eyes, featuring high-profile stars like Erling Haaland taking the global stage. Which leaves us with the ultimate question as we wrap up today's briefing. We've seen the incredible trillion-dollar momentum of tech, and we've seen the heavy, unyielding weight of the everyday consumer's financial reality. So I leave you to ponder this. How long can the gravity-defying AI sector continue to drag the consumer anchor forward before the rope finally snaps? Thank you so much for joining me for this explainer. Keep your eyes on the data, and as always, keep learning.